For all the chaos in the global economy, some things haven't really changed. The vast majority of banks that were in business prior to the financial crisis are still standing. The purpose of banking is pretty much the same. Banks provide a safe haven for the savings of individuals and businesses. They support economic growth by efficiently and effectively allocating funds, and they bridge the divergent maturity needs of short-term depositors and long-term borrowers. If the global financial crisis has demonstrated anything, it's the continuing and essential value of these services to society. So the fundamental needs of banking customers are unchanged. Individuals and organisations need bank accounts and services that enable them to hold cash, make transactions. They need access to credit to enable investment and economic advancement. Customers need savings and wealth creation vehicles in which to invest their money, and they also need periodic advice on their financial situation and appropriate products and services. So what then is different? In an increasingly globalised market where there is a wealth of choice and information available to customers, businesses can only survive if they're able to adapt and innovate to the changing needs of their customers. In the past, innovation has been about technology and control of quality and cost. But in today's economic environment, innovation needs to go beyond that. It's about taking businesses built for efficiency and rewiring them for creativity and growth. And to do that by understanding the changing habits of the consumer and being able to respond to those needs. And it's from this that banks will be able to offer solutions and support to generate the growth potential of the businesses who work with them. When I came to Santander 4 years ago, our challenge was to build a credible corporate bank to challenge the 4 major banks that dominated the market, and not by falling into the trap of competing on price or risk. We saw ourselves very much as an insurgent, and in that situation you have to be innovative. You cannot compete with the incumbents on their terms, as they have the size, the brand, the reputation, and therefore the power. You have to be something different in a market and exploit areas where they would find it difficult to compete. We felt we could be different through the relationships we build with our customers. Banking's a people business, and I think great customer experience is about having a real connection, about really wanting to help someone, and this is something that the incumbent banks have actually found it increasingly hard to do as they've got bigger. So our approach was to position ourselves as the bank that people aspire to be with because they value the relationship, they value the advice they receive. Our relationships are built on meeting the needs of customers by listening to them, spending time with them and getting to understand their business, and then working with them to provide solutions that reflect that understanding. And it's something that's worked pretty well for us. In the last 4 years, we've grown our lending to SMEs by over 20% each year. And when I look back at some of the businesses we have won, whilst pricing is undoubtedly always mentioned, more often than not, what sealed the decision to come to Santander was that we spent more time getting to know the customer, we showed a greater understanding of their business, and in return the customer felt that we cared about them and their business. It's actually quite hard, as I said before, for an incumbent bank which has significant scale and a massive distribution capability to try and create that connection with customers, which is quite intimate. Turning to the regulatory environment, the Independent Commission on Banking report will undoubtedly impact the future shape and direction of the UK banking sector, and in particular business banking. How it will impact individual banks will be very much dependent on their business model and how they structure themselves to suit their business objectives. One aspect the Vickers report failed to highlight is that how customers will be affected by these different models. Some banks will have a very wide ring fence containing almost all the services which customers need, and other banks may choose to make the ring fence as small as possible, i.e. just deposits and overdrafts, so that a wider service can be provided from the wholesale bank. With little clarity on how the ring-fence bank and the wholesale bank will work together, the customer experience will certainly be very different across the sector. This will become very apparent for small businesses who in one breath are being encouraged to export but could find it increasingly difficult to operate currency accounts that some banks may choose to place in their wholesale bank rather than within their ring-fence bank. The proposals also insist that ring-fence banks hold higher equity and have lower leverage ratios, and certainly way outside the norms that are being talked about under Basel III. But the reality of the financial crisis is that the banks failed because of their indiscipline and because of market indiscipline, rather than monetary or fiscal indiscipline. And if we look at some of the banks that failed, they would have needed 20, 30 or even 40% of capital to ride out their issues, which nobody could even ever reasonably suggest is a viable business model. Banking has always carried maturity and counterparty risk. It takes predominantly short-term deposits from good quality investors and invests them over longer periods with hopefully equally good quality borrowers, backed with appropriate collateral. The insurance or risk buffer between the term and borrower risk is capital. But like insurance, it allows you to repair the car. It doesn't stop you having accidents, particularly if you drive recklessly and ignore the road signs. So if we look at the loss absorbency measures that are recommended within Vickers, they may well facilitate the resolvability of banks, but at a significant cost to the industry, and by definition at a significant cost to those people who need the industry to fund their growth. A key point for the UK government to perhaps consider is that we could find ourselves in the UK implementing these high loss absorbency measures ahead of the European Union and other jurisdictions, which will significantly increase the cost of funding for UK banks. That will be extremely challenging, not only for UK banks, but will have a material impact on the wider economy. Our economic recovery in the UK is very much dependent upon the private sector, and for the private sector to lead the recovery, it needs access to capital. In the past, that capital has flowed from the banks. But with additional capital and liquidity requirements on the banks, that will not be possible going forward. Sure, banks can cut their costs, but the costs of funding and meeting the regulatory requirements far outweigh all other costs. So from my point of view, it is imperative that the government, as it seeks to implement Vickers, seeks to remain aligned with international implementation to give us the best opportunity to be competitive. So in other words, sensible regulation that supports growth. So after a tough year for banks, in fact, a tough few years for banks, both in terms of the strong economic headwinds, increasing stringent regulation, we can't afford to stand still. We need to adapt. In this market, innovation means intelligent growth. Less capital and liquidity is available, so we have to make sure that we apply it in areas where we get the greatest benefit for our customers and for our stakeholders. We have to keep innovating in terms of products as technology develops, and so do our customers' expectations of how they interact with us, how they want to carry out transactions, and the solutions that they want us to provide. In Santander, we pride ourselves in our ability to deliver on understanding our customers. Recently, we launched the Santander 123 current account and credit card, which rewards customers for the transactions they make. Although 123 products have an annual charge, both of these products have been hugely successful. Around 25% of our credit cards are 123 accounts, but they account for over 60% of the annualized spend. In business and corporate banking, we have just launched Breakthrough, an initiative designed to identify the best entrepreneurial companies in the UK and help them achieve their full potential. Small and medium-sized enterprises are pivotal to the success of the UK economy, vital in terms of job and wealth creation. But it is these entrepreneurial companies led by strong, ambitious management teams, underpinned by carefully considered growth strategies, that most often struggle when it comes to accessing funding and resources. The Santander Breakthrough programme will invest up to £200 million in fast-growth small and medium-sized enterprises. But it's not just money that drives growth, it's people. So alongside that financial investment, we've established a programme of free support to help business owners overcome barriers, accelerate their business growth, trade outside the UK. This is the type of innovation that the banking sector needs to consider as it works with businesses and helps to support the UK recovery. Of course, alongside that, over the next few years, we will have to adapt, both in retail banking and in corporate banking, the way that we connect with our customers, particularly in the space of mobile banking technology, apps for iPhones, iPads, and so on and so forth. So whether you're a bank or a business, you need to adapt. You need to challenge the status quo and truly understand your customers and their needs if you're going to be successful.